Turning Japanese, is that what's happening to the U.S. economy? We're debating the issue all week long on the Inside Track. Yesterday, Nomura's Paul Sheard told us America doesn't face a Japan-style lost decade because we don't have a deflation problem. This morning, another view. Paul Dales is the senior U.S. economist at Capital Economics. He's in Toronto. So, Paul, have we successfully avoided a lost decade here in the United States?
Well, we don't exactly know quite yet, but we're 3 years into a very severe recession and very weak recovery. So we're 30% of the way there, if you want to put it that way.
And has the policy response from the likes of Ben Bernanke and others been strong enough, in your opinion, to head off a lost decade, a Japan-like experience? Because people I talk to all the time say, hey, yeah, a strong policy response perhaps, but we are treating the same ills with the same medicine. Maybe it doesn't matter how much medicine you give the patient if he's suffering from the same disease that afflicted Japan.
Well, this is the interesting point. There's been quite a lot of complacency in the US that we wouldn't enter a lost decade simply because the policy response in the US was bigger and quicker than that in Japan. But despite that, the fact is that the US recession has actually been deeper and longer, and the unemployment rate has risen by more. So even though there was more medicine given, the actual patient has suffered even more. So I think this is particularly worrying, as it means that traditional forms of policy stimulus are becoming less effective. And so there really is less the policymakers can do to actually sort out this problem. And I think that is one of the big issues that is going to really play out over the coming few years, where further steps towards solving this issue actually don't produce much results. And that's the problem that has really hit home with the experience of Japan.
So what are the options then, Paul? Everyone's talking this week about Ben Bernanke perhaps having to make some allusion to QE3 or even announce it outright at Jackson Hole. The market is pricing it in. But based on what you're telling me, it doesn't sound like QE3 would do the U.S. economy a whole lot of good if we're using Japan's experience as a guide.
Well, I think that's right. I mean, Ben Bernanke has been incredibly proactive as the chairman of the Federal Reserve, and he's done a lot more than most people expected. And I suspect he will continue to do that. But we've seen with the first two rounds of quantitative easing that they are very much a short-term gap. They give a temporary boost to the economy and a temporary boost to the financial markets. But then that fades very quickly. The problem is that monetary policy is generally designed to reduce the cost of borrowing. But if people don't want to borrow regardless of the price, which I think is the issue in the US at the moment, then monetary policy becomes less effective. Does lowering long-term interest rates from 2.5% to 2% make much difference when households are simply unable to borrow? I think the answer is no, they don't really make much difference at all.
So, Paul, what is the answer then? Do we just not do anything? Do we go through the painful deleveraging process that seems to be inevitable, a restructuring, if you will, of the U.S. economy, and once we come out on the other side, we can look forward to some genuine growth instead of, as you put it, putting off the inevitable because the economy doesn't respond all that well to the medicine it's getting from the Federal Reserve. The patient is still sick, he's still in hospital, and he hasn't really gotten much better.
Well, I think the ultimate cure is actually time. So we will just have to sit it out and wait for this deleveraging process to take place. But in the meantime, I do think the policymakers do need to be proactive. If your tools are less powerful, then the answer is simply to use them more. And also, in theory, I think that fiscal stimulus could actually be quite productive, especially if you were to put in place infrastructure spending projects, which don't really rely on the whims of households to determine whether they are successful or not. But as we know, the problem at the moment is that the fiscal debate has moved away from fiscal stimulus and towards fiscal consolidation. So that's another problem. I do think, in theory, there are tools that can solve this mess, but certainly in the political environment, those tools aren't going to be able to be used to the full.
So, Paul, I have to ask you a question that always makes economists uncomfortable. Given what you just told me about the fiscal debate and how we're moving into fiscal contraction as opposed to fiscal expansion, what are the chances? I mean, give me a probability. What are the chances that the U.S. ends up in a lost decade?
Well, you're right. Economists don't like that question. But I think the chances are higher than everyone really expects. We're already 3 years away from the financial crisis. And in a couple of years, I suspect that economic growth will be as weak as it is now. And the unemployment rate will be almost as high. So then we'd be halfway to a lost decade without really realizing. So I think the chances are pretty high. I think we can pretty much conclude that the years of economic growth of 4 and 5% that became the norm in the late 1990s and early 2000s are really behind us. And we do really need to get to a new period where economic growth of around 2% per year is pretty much all we can expect.
Paul, thank you. No number, perhaps, but the chances, he says, are pretty high that we end up in a lost decade. Paul Dales is the senior U.S. economist at Capital Economics.